When you have times of, let's call it great geopolitical upheaval, it gives us an opportunity to look at various things within markets and see whether the hype matches what is happening in reality. And we can do this because these events act as a form of stress test upon various instruments, upon various markets, upon various trading strategies. And so you get a real-time test of what is actually happening. And this is often a little bit easier for us than trying to look back into history and to divine what was happening in markets at that particular time, particularly with regard to the psychology of traders and the cultural impact of various events at the time. And with the current events in Ukraine, I thought it would be very, very interesting to have a look at that most overhyped of all commodities, gold. There is this notion that whenever anything occurs in the world of any significance whatsoever, that gold automatically explodes in value, that it automatically makes various investors magically rich. And in fact, as the situation in Ukraine was unfolding, my LinkedIn feed lit up with grown men who went all giggly and tingly in their nether regions because they thought gold was going to do magnificent things. Granted, they tend to come from a certain generation, and they tend to come from my generation of investors or traders. I suppose the current cultural term for them would be boomers. They have a very much an emotional link to gold, particularly here in Australia, where it seems to be just one of those things that people become fixated on. And unfortunately, what this tends to do is cloud one's thinking. And in fact, I had many grown-ups on my LinkedIn feed trying to tell me that gold was going to go straight to $5,000. I, along with the rest of the market, are still waiting for that. But when you actually look at gold and as to the reasons as to why you should buy it, the reasons that are generally given are these three: long-term returns, hedge against inflation, and perhaps the most nebulous of the lot, which is this notion of a hedge against uncertainty. As with all things, when you make these sort of very solid claims, you do set these claims up for testing. You do set them up for people to come along and say, well, is this actually really true? And so this is what I actually want to look at. And so I'll start with this notion of returns. There is this notion that somehow gold provides a magical return and is somehow a long-term store of wealth, which is a claim that's actually very, very easy to test. And so what I've done here is going back to 1969, and I've picked 1969 for a reason, because it's when we began to move from what I would call, let's call it a very analog mechanism of dealing with things to a more digital way of dealing with things. The movement of information started to become freer. It started to become more fluid. And so we're getting the early elements of a transition point in markets, where markets are moving from being quite slow and cumbersome, slowly towards what we have now, where markets effectively move at the speed of light. And so you can see this transition from old school to new school. You can also see a transition in geopolitical events. The 1960s, early 1970s were a time of, let's call it, fairly substantial upheaval. And what we can see here is the annual percentage change in the price of gold and the annual percentage change in the price of the S&P 500. And I've just matched them together year on year. You can see in the early 1970s through to 1979, there was a great deal of outperformance in gold. 72, 73, 74, we can drop into the basket of the period of the oil crisis. We've got the Yom Kippur War in Israel in 73, which led to the OPEC oil embargo on the US. we have another event of a similar type in 1979. And this is interesting because it gives us a clue to something I'll talk about in a moment, and that is that gold might not be linked to geopolitical events, but it might actually be linked to a second-tier effect, which is a movement in the price of oil. What we see here is those very large spikes in the 1970s. They then dampen down. And my rationale for this dampening down is not that there has been a decrease in the number of events, as we will see in a moment, but rather markets have become more efficient and they've become more open to alternative sources of investment. And I think in part this is part of the problem that gold actually faces. Back in the day, gold used to be the thing. Gold is no longer the thing. I remember vividly during the outbreak of the Gulf War, there was talk that gold was going to go through the roof again, as Arab nations sought to protect their wealth by buying gold. They didn't. They bought foreign currencies. That's an example of the world changing. And investment themes and trends change as the technology which enables us to deal with them changes. This chart doesn't give us much of an insight into the notion of gold as a sort of long-term store of wealth, nor does it give us an indication of sort of the long-term return you would get from holding gold. To do that, we actually have to assign a dollar value to it. And in this chart, what I've done is I've gone back to our starting point of 1969, and I've looked at a dollar invested in the S&P 500 total return index versus a dollar invested in gold. Gold sucks. Gold is a terrible long-term investment. Its return is, let's be generous and say it's a quarter of the long-term return you would get from investing in the S&P 500 total return index. The notion that gold is a long-term store of wealth is a silly one and is not simply backed up by the evidence whatsoever. But then we come to the other chestnut of gold being somehow a hedge against inflation. And once again, we can investigate this because the data for inflation is freely available, as we've seen, data for the price of gold. So what we should actually see is that during times of high inflation, and traditionally high inflation is regarded as being above 5%, the price of gold should explode. And when I look at mapping the price of gold versus the US inflation rate, we find an almost non-existent relationship. We find that the relationship at best could be categorized as weak, with there being very, very few spikes in the price of gold versus the headline inflation rate. And we can get an additional sense of this when we graph year-on-year returns in inflation versus year-on-year change in the gold price. What I've done is I've dropped a horizontal line across here, which is the 5% mark. This is somehow our magic benchmark that has been chosen by economists. And you can see once again that there is not much of a relationship. Even in the 1970s, when we had periods of great change in the price of gold, these were not set off, it seems, by great change in inflation. These were not generally high inflationary periods. Inflation wasn't low, but it was not rampant and it wasn't runaway. But the price of gold for this particular point in history was. So that nexus that is often presented to us is actually very, very weak. And then we come to this somewhat nebulous point, which is that gold is a hedge against uncertainty, whatever uncertainty might be. And I said before that when we looked at the long-term price of gold, that there had been a dampening in what was occurring, a dampening in the rate of change in the price of gold. But there's been no dampening in geopolitical events. They're still occurring at a rate that I shouldn't say we would expect, but is not abnormal. And so if you look at the past 2 decades, since the turn of the century, what I've done here is we've got the year, the return that gold has generated for that year, and whatever event was occurring at the time. And you can see that we kick off the new century with the oil price bubble, the subprime crisis, the US housing bubble, the Russian financial crisis, which seems to be an ongoing event, the European sovereign debt crisis, which took time to unwind. Once that got going, it took a very, very long time for the European Union to unwind that and to fix it. We then have the Russia-Ukrainian war. Many people think that this war started a few weeks ago. It didn't. It started many, many years ago with Russia's moves to annex provinces around Ukraine. And then, of course, we've got the joys of COVID, which seems to be the gift that keeps on giving. So you could categorise the early 21st century as a period of uncertainty. There were a lot of geopolitical events and economic events occurring, which as a cascade should have driven the price of gold through the roof. And we did have some periods of very, very good performance. But once again, if we look at the average long-term performance, we see that the average long-term performance of the S&P 500 Total Return Index was 9.76%. That includes the smack the market took from the collapse of the US housing bubble, the remnants of the dot-com boom, which ushered in the 21st century, and the belt it took from COVID unwinding, versus the average gold return of 10.06%. I don't see a lot of massive outperformance there. I don't see a lot of long-term return, and I don't see a generalised guarding of somehow this magical shield against uncertainty. But I did mention before that there is an interesting relationship between the price of gold and the price of oil. And you could make the argument that geopolitical events throw the price of oil up, which in turn throw the price of gold up. And to be honest, I'm not that convinced. It's an interesting relationship, but it is not a brilliant relationship. And there are points where the nexus falls apart. But you could argue it's part of this throughput of things fall apart to make the price of oil go up. The same things that make the price of oil go up make gold go up. But then gold doesn't go up as much as people think. When we come to look at any commodity, any instrument, any tool, the sort of proof of being useful is how many useful trends it actually generates for us to trade. How many times does it go up in such a manner that in lieu of commissions, the cost involved in timing, because timing does impose a cost because you don't get all of the move, there is an ability gap. What does that do for us as traders? And what I've done here, this is just a very, very long-term chart of gold, so you can consider this to be intergenerational for traders. And I've dropped on a tool called Zigzag, and I've simply done this so it draws these very sharp demarcations on moves that are 10% and above in terms of their change in price. And you can see it looks like there are some moves in the price of gold that can be traded, and that's true. But there's a few things to note, and this is one of the things that often catches traders. It is they fail to look at the time scale. gold effectively had a bear market of 13 years and 4 months where it went nowhere. Oh, the other thing I should mention is that my testing, my experience, and the literature seems to indicate that the shorting of precious metals is a losing game. So in this, I'm referring to long-only trades. But if we come back to this point of congestion, gold, on a conservative measure, went sideways for 13 and a bit years. It offered traders very, very little in the way of tradable trends. And in fact, if I was being strict in my technical interpretation of this, it took gold 18 years to make a new high, to move out of this range-bound congestion and actually get going. Granted, you get some of this early part of the move, but if we look at the actual rate of climb of the trend itself, it's actually quite modest. If I change the time scale, and this is now weekly as opposed to monthly, and again, looking at those moves of 10% and above, we can see again, over the past generation, there's actually only a handful. And I would actually say, being somewhat cynical, that in reality, there are only a small number of moves, and these are indicated by the width of the blue box. The wider the blue box, in my opinion, the more tradable a move becomes in terms of being able to pick up parts thereof. So where you have very skinny boxes, these are short, sharp moves. They're very, very difficult to catch. And looking at this, there's really only 3 true bull markets in gold that have any longevity. And that is part of the problem in trading something like gold. I would even posit to say that if you miss the move of sort of 2001 to 2008 and then 2009 to 11/12, you've missed a large part of what gold offered in the past 2.5 decades. Granted, 2019, 2020, fairly decent move. But what is interesting is, with a full-blown war in the centre of Europe, which does have the potential to get out of hand, you're still not seeing a dramatic move in the price of gold. We're still stuck with the very, very good trends having been in the past, and the ones we've got now being very, very short and very, very sharp. And gold is simply not, as the people on my LinkedIn feed say, giving any signs of going to $5,000. If anything, from a technical sort of observation, it's much weaker than it should be. And that is once again probably because, in terms of a hedge against uncertainty, it is not what people perceive it to be. My view of that is very old school thinking. There are now new mechanisms of moving money around very, very quickly and ensuring that it holds its value. And just an aside, the other interesting thing I would observe is that Bitcoin is thrown up as a hedge against uncertainty. It is the new form of money. The intriguing thing is that Bitcoin itself is struggling to move ahead. My expectation is that these elements that have a high speculative element to them is that they would be exploding in value. And this brings me to sort of my conclusion, my final point. And that is that it is necessary as a trader to trade the trend and not the hype. Many commodities, many instruments have very, very good marketing. Gold has very good marketing. If you look at LinkedIn, you look at Twitter, you look anywhere, it has exceptional marketing. There are all sorts of people flogging gold as a brilliant investment. But the question you have to ask yourself is there hype matching what is actually on offer for you? So that as a trader, you have to keep in the back of your mind that it's quite possible for markets to do this, and markets do this. Equity markets do this. Other commodities do this. They go sideways for years and you're simply stuck in a non-performing asset. So we come back to a very, very simple conclusion that people often miss. And that is that you trade the trend and not the hype.